Welcome back to the deep dive. We're here to cut through the noise, to take on all that dense research, and really pull out the knowledge you need to be strategic.
hmm
Today, we're getting into the real heart of building wealth. We're talking about the strategic habits, the things that decide how well your money actually works for you over the long haul.
That's right. We've been completely immersed in the sources you sent over a great stack of financial planning excerpts, all centered on this idea of épargne d'investissement.
Which is what? Just investment savings?
Just investment savings, exactly. But it's about the money specifically set aside for long-term growth. And this is the key. It's capital that's designed to accept risk, to accept volatility.
Because what the material really hammers home is that, strategic planning is so much more about discipline than it is about just having a huge amount of money to start with.
It really is.
I loved how they frame it, the preparation you have to do before you even think about picking your first investment. They had this analogy.
Under the army analogy, yeah.
Money ready to be invested is like an army waiting. Useless without strategy, formidable with. Our mission today is to build out that strategy.
It is. We're going to distill the absolute core principles, how to separate, how to structure, and then how to deploy this capital to build what they call your patrimony.
Which for most of us just means our long-term net worth, our wealth.
Your lasting wealth base, exactly.
And, before we dive in, we should probably do the usual reminder. We're pulling all this directly from expert financial documents, but this is educational. It's general information.
Right. It is not personalized investment advice for you specifically. Always important to say.
Okay, so let's get into it. The first big concept, separation.
The foundation.
The sources call this the non-negotiable rule. Can you sort of walk us through why this firewall is so critical?
This is where it all starts. The rule is you're only allowed to invest money that you absolutely will not need in the short or the medium term.
And we're talking, what, 3, 5 years?
At least. Ideally 10 years or more. This separation, it's everything.
Okay, so why be so strict about that? Why does my investment money need to be so aggressively walled off from my regular savings?
Because it's the only way you can keep your head straight when the market drops. Investing, it requires taking on risk. It requires accepting volatility.
Which can be scary.
It could be very scary.
Mm-hmm.
But you can only freely take risks, as the source says, if you know for a fact that your day-to-day life doesn't depend on that money. Your emergency fund, your vacation savings, that's all covered. Separately. Safely.
That makes a ton of sense, because the fatal mistake they keep mentioning, the big pitfall, is when real life crashes into your investment plan.
Exactly. An emergency hits, you lose your job, the roof starts leaking, something medical, and suddenly you're forced to sell.
And you're almost always selling at the worst possible time.
Always. You sell low, you lock in a loss, and those losses, as they say, can never be recovered. That one event can set you back years, so that firewall has to be absolute.
So, it's okay, let's say we've built that fortress. We have our investment savings completely separate. The next big principle seems to be about time and discipline.
Right. The objective is clear. Building your patrimony, your wealth over the long term. This is a game of decades.
And this is where that powerful resource comes in, the one that's so easy to underestimate.
Time itself. Time is your single greatest asset, all because of compounding. The material is so clear on this. The sooner you start, the more compound interest works for you.
But what about for someone just starting out? The amounts can feel derisory, I think was the word they used. Tiny. Why is starting with a tiny amount now so much better than waiting 5 years when I can invest more?
Because the growth from compounding isn't linear. It's exponential. It's interest earning its own interest.
Mm-hmm.
We can make this real. Imagine two people.
Okay, let's call them Alice and Bob.
Perfect. Alice and Bob. So Alice starts investing $500 a month when she's 25. She does it for 40 years, right up to 65. Bob waits. He doesn't start until he's 35. He also invests $500 a month, but for only 30 years. Now, assuming a pretty standard 7% return, Alice's money has had a whole extra decade to grow on itself.
And the difference is huge, isn't it? That 10-year delay costs Bob, what, hundreds of thousands of dollars in growth he missed out on?
It's massive, even though he only put in $60,000 less of his own money over time. The sources show that the habit of starting is more important at first than the actual amount.
Which leads right to their target number.
Exactly. They advise dedicating at least 10% of monthly income to investment savings. If you could do more, even better. But 10% is the target.
So it's about building that muscle first, that consistent automated habit every single month. The rest sort of follows from there.
You've got it. If the habit is built, The really hard work is already done.
All right, let's get a little more technical. We've got the mindset, we've got the discipline. That 10% is being set aside. But where does it physically go before it gets put into stocks or whatever?
You've hit on a really critical, practical step. The holding account. The parking spot.
The staging area.
The staging area, yes. This money, your capacity to invest, should first go into a super secure, zero-risk, regulated account.
The sources mentioned some specific French ones, the livret A, LDD, things like that. For people listening elsewhere, what's the function we're looking for, not the name?
The function is everything. You're just looking for a highly liquid, government-backed, or regulated savings account. The capital is guaranteed. It's the safe staging area that keeps the firewall intact. It separates your investment cash from your checking account and from the markets.
So let's be super clear. Putting money into one of these accounts is not investing yet.
Not at all. It is simply the first step of securing the capital before you deploy it.
And these accounts have certain characteristics.
They do. The time horizon is very short, like less than a year. There's basically zero risk, and the liquidity is immediate. You can pull the cash out instantly to make an investment.
But there's a big downside for all that safety, a huge one. The material is blunt about it. The yield warning is that the return is negative when taking inflation into account.
So you're losing purchasing power.
You are. These accounts are purely for safety and availability. They're a structural bridge, not a growth engine.
Okay, so once the capital is sitting in that safe staging area ready to go, the next big question is how? Do you save up a big chunk and invest it all at once, or do you invest little bits every month?
The general principle they lay out is pretty clear. It is much simpler and far less risky to invest small amounts regularly every single month.
This is that strategy, dollar cost averaging.
That's the common term for it, yeah. Our sources call it smoothing the risks. Listen les risques.
So walk us through why that's so beneficial, especially when markets are, going up and down.
Well, when you invest the same dollar amount each month, your money automatically buys more shares when prices are low and fewer shares when prices are high.
Yeah.
It's just math. It lowers your average cost over time. And if there's a big market drop, you've only put in small amounts. You're not fully exposed. And by continuing to invest, as the source says, you can benefit from this decline by continuing to invest at a lower price.
That makes total sense for someone building up their savings, but let me play devil's advocate for a second.
Go for it.
What if I get a big windfall, an inheritance, a bonus? If I split that up over 6 months, but the market shoots up 20% in that time, haven't I just lost out on a huge gain by holding back?
That is the classic debate, and the sources address it head on. And yes, if the market immediately rallies, you miss some upside. But the bigger, more devastating risk, especially for a newer investor, is putting that whole lump sum in right before a crash.
Right before a 2008 situation.
Exactly. If you go all in and the market tanks, the time it'll take for you to just get back to even could be years. That's a huge psychological blow. It might even cause you to panic and sell.
That fatal mistake again.
The fatal mistake. So the solution they advise is to just divide the big sum into smaller pieces, invest them gradually each month over 6 months, over a year.
You're basically creating your own stream of regular investments.
You are. You're smoothing the risk of bad timing. It's protection against the worst case scenario.
This has been incredibly useful, really breaking down the philosophy before you even get to the assets. So before we wrap, let's just synthesize this. What are the 5 mandatory takeaways? The rules that have to stick?
Let's lock them in. These are the non-negotiables.
Okay, 1, start early. You have to maximize that incredible power of compound interest.
2, build the firewall. Only invest money you will not need in the short or medium term, period.
3, avoid urgent selling at all costs, which means your separate emergency fund has to be solid.
4, start small, but be regular. Use that dollar cost averaging to smooth out the ride and even benefit from dips.
And 5, aim for that discipline, at least 10% of your monthly income going into that investment pot.
And while those steps give you the structure, we have to ground this in reality. The sources are very clear about personal responsibility. Market performance is uncertain. Past performance is never, ever a guarantee of future results. Every single investment carries risk.
Which is why you have to internalize this knowledge, really understand it, not just follow it like a checklist.
That's the whole point. And it brings us to this final thought from the source material. It's a quote often attributed to Charlie Munger.
What's that?
Take ideas where they are, but use your own brain to assemble them.
I love that. So if these core principles, the firewall, the 10% target, starting early, if that knowledge is out there for everyone, then the real skill is figuring out how to assemble it into a strategy that fits your life, your goals, your timeline, your stomach for risk.
Exactly.
So the question to leave you with is, what's the next research step you need to take right now to connect these powerful general principles to your own specific situation?
That's your next deep dive.
Before you go do that, make sure you add a like to this deep dive and subscribe to the channel. You won't want to miss the next one. Until then, keep digging.
We'll see you next time.